Good afternoon, guys. Welcome to the podcast. And I've got a very special guest for you today, David Doss, MBA from New York City. He is in the asset management business. He's actually he manages funds focused on digital assets, which we'll talk about all today. It's really going to be a very fascinating conversation. And I'm really happy to have him on the show to talk about his work. So, David, welcome.
Thank you. Appreciate you having me on the show, Dr. Chris.
Yeah. I love to keep the podcast informal, so everybody calls me Chris. And yeah, just talk about what you do and how you got started. I'm really excited to dive into the questions.
For sure. Yeah. So as you mentioned, I'm a fund manager focused on the digital asset space. So I've worked with a lot of, leading brands and companies on fintech innovation, including digital assets. So that's been at Citigroup as well as a variety of other organizations. And essentially what my team and I look to do is to provide people with expertly managed solutions to diversify into this exciting emerging asset class in a way that properly takes into account risk mitigation and other best practices that people rely on in their more mainstream parts of or mainstream assets and main parts of their portfolios.
Mhm. Yeah, really interesting. And so when people talk about digital assets, the granddaddy is Bitcoin. I know your strategy may be proprietary, but just talk about how you invest or diversify or maximize gains and minimize risk for clients.
For sure. Thinking through other assets, we look to provide those types of tried and true approaches from other spaces. So let's say we were talking, you and I, a little bit about equities and real estate, right? Which is, I think, what a lot of people are most familiar with. What our point is here is that digital assets are special, just like any other asset class. So when you're talking about real estate, you might use the term cap rate instead of ROI, but the math is still the math, right? Somewhat similarly with cryptocurrencies, there are multiple different cryptocurrencies out there. There are different use cases, different types of fundamental value, right? An example I would use is if you're going out and buying stocks, most people, they would not just go and purchase whatever the number one by market cap flavor of the cycle is. So they wouldn't just throw all their eggs into the basket of Microsoft, for example. But yet that's often what people do in the crypto space is they'll just buy Bitcoin, right? That being said, much like in the stock market, there are thousands and thousands of different digital assets, different digital crypto or different cryptocurrencies out there, right? So in the stock market, you have verticals such as healthcare, industrials, financial services, technology. In the cryptocurrency space, you have different use cases such as DeFi, smart contract platforms, exchange tokens, decentralized file storage, stores of value, more kind of commerce oriented use cases. So, very similarly, what we look to do is do all of that nitty gritty research into the different assets in the space, conduct fundamental and technical analysis, build out a portfolio of diversified assets across these different market caps, different verticals, and then to adjust them and rebalance that portfolio as market conditions shift, much like a equities portfolio manager might do.
Mhm. Yeah, interesting. We'll talk about the digital asset market is highly volatile and still in its infancy. So, what strategies do you use to help family offices and high net worth individuals maximize returns while mitigating risks?
Yeah. So it's a very important question, I think. One of them is that diversification, right? When certain areas, again, to that point about, say, the stock market, when a healthcare and medical type of assets are doing badly, perhaps financial services assets might be doing well. You see somewhat similar behavior in the cryptocurrency market that essentially there are pockets and pockets, and some of this is a bit more, let's say, trend driven, week on week or month on month. Others are more cycle driven, that certain narratives really will dominate a more multi year cycle. So we look to provide a broader exposure to the different ways that the cryptocurrency can provide value, so that investors can capture basically the upsides across the spectrum. The other aspects are also thinking of digital assets in and of themselves as a risk mitigator for a broader portfolio. You look at the behavior of digital assets as compared to equities or real estate or other, let's say, popular mainstream assets with more established adoption. You will see different behaviors of the market. For example, when bonds were suffering over the last couple of really, there was also in certain bond markets you had actually a decade long kind of slide where digital assets were going up, right? And real estate prices undergoing volatility on a kind of a different pattern than digital assets. You saw also the stock market being much more susceptible to sell-offs during COVID, for example, than the cryptocurrency market. Point being, in general, markets carry risks. Having a portfolio of different assets in different asset classes can help to smooth some of that out. So what we see there is that the role of digital assets is as a small but mighty hedge against the volatility of a larger portfolio, where really depends on the person or the institution, the group. But generally speaking, a lot of people will see value in allocating somewhere between 1 and 20% of a portfolio into the digital asset space, which that's the minority of a portfolio. Many people will prefer to have most in stocks or real estate or bonds. But that being said, that minority allocation can do a lot of heavy lifting of basically zigging when the other parts of the portfolio are zagging, so to speak, as well as having an asymmetric upside opportunity, where this is the type of position where 2x, 5x, 10x type of growth in fairly short periods of time is not at all unheard of, right? The risk adjusted return of having a small piece of the portfolio really knock it out of the park is something that many people find quite appealing. And then the last part of the risk mitigation side of things is basically the infrastructure in place. So things like institutional grade insured storage providers or monitoring and alerting solutions, these sorts of things that a lot of people day to day might not have access to, are things that as professionals focused on this day in and day out, we can essentially get those solutions in place at a lower cost basis through collective bargaining power.
Interesting. And one question I have for you, and again, this is not advice for the audience, but what particular tokens or coins are you looking at? Is it just the big three, or is it just across different sectors? Feel free to elaborate.
Yeah, for sure. We look at a fairly broad mandate, but within limits. So the thing about the cryptocurrency market is that it has a very long tail. Point being, you have about tens of thousands, depends on how you define it, but tens of thousands of different cryptocurrencies out there. That being said, Bitcoin itself can have anywhere from 30 to 50% of the total market cap value. So that means that the 1,000th ranked is infinitely smaller in size than Bitcoin, and then the 10,000th ranked is infinitely smaller than that, right? The point there being that the proportions need to be properly considered. But broadly speaking, we look at top 1,000 assets, which, somewhat similar to how someone might look at, let's say, S&P 500 type of assets under a certain lens. And then within that, we look to have exposure across multiple different sectors. The types of sector that are hottest at any given point, be it, for the month or the quarter or for the year, that will really depend, as it will in any market. In real estate, sometimes commercial is doing better than residential, or maybe class C is doing better or worse than class A at any given point, right? Somewhat similar here. But I would say right now, for one thing, the narrative is fairly dominated by a couple of trends. One is the DePIN type of subsector, so decentralized physical infrastructure, this Internet of Things and related types of use cases. is something that a lot of professionals inside and outside of the space seem to be very much focused on. Another would be essentially next generation smart contract platforms and DeFi, decentralized finance solutions, where in this overall, we are at what seems to be let's say, closer to the beginning than the end of this current bull market in the cryptocurrency and digital asset space. And what we're seeing is a net outflow from some of these top protocols into basically more kind of the small and medium protocols, which are offering better deals. So people are starting to be a bit more tolerant of risk and focused on basically the small to medium players, which can really outshine the more dominant ones in terms of their upside, their return potential for investors.
Interesting. And then there's so much we can cover, which is really interesting. And how do you do your due diligence on a lot of these new, like basically, does your fund basically have access to Coinbase or like MetaMask and then basically can go through decentralized exchanges and buy these tokens? Or are these ICO tokens, or how do you elucidate that process?
Yeah. So in terms of what types of assets, generally we look to allocate into positions that are high liquidity. So we generally shy away from ICOs and pre-sales because they often come with lockup periods, where ICO investing is really a lot more like venture capital investing, where you've got these, maybe in some cases, 5-year lockups. There's a lot less liquidity. Whereas investing into exchange traded tokens that are already live and have an overall volume is something where we can move in or out of the positions at will, depending on what's going on. This is more akin to, say, something like the stock market, at least compared with the ICOs. In terms of the due diligence and research part of it, we look at a lot of different factors. So we'll go in and conduct a very nitty gritty fundamental and technical analysis of what is the use case, what is, say, the revenue of platform, kind of somewhat similar to how you look at price to earnings ratios in the stock market. At more other indicators like VWAP or other kind of, let's say, weighted averages type of metrics. Also look through the charts, really just looking at from multiple different angles. Does this make sense as a business case? Does it make sense in terms of the market sentiment around it? And those are things that will change on an ongoing basis, where this is a 24/7 market, and what the picture looks like today is not what the picture is going to look like next week or next month or next year. And then from more infrastructure perspective, which is what I think you're also referring to, is we have we have basically our own tech stack in place of partners that we work with, these sorts of things. So we have a combination of, say, cold storage, meaning offline, where it's harder for something to get hacked. We also have insured custody providers that can help mitigate the risk of the kinds of things that you'll hear about in the news sometimes. We also work with more institutional, both centralized and decentralized exchanges that can handle the quality and quantity of activity that we deal with as an institution.
Oh, interesting. Yeah, that kind of really sheds light on a lot of your processes. And shifting gears, the Fed dropped interest rates recently and the market's kicking back up. And some people are saying a recession. And then I know other camp is like no liquidity, and that's going to be really good. What is your view, or what is your team's view on the interest rate environment, the economy, a new administration, possible new administration, regulation? We got the Gary Gensler. How are you viewing all of these coming after November?
That's so. How much time do you have? So I'll try and touch on some of the greatest hits here. In general, I think that the market will see many markets, including cryptocurrency, likely picking up further after elections, regardless of who wins. I think just certainty in the political sphere leads to more confidence in markets in general. There is that. I do think that cryptocurrency in particular has been a major talking point in this particular election cycle. So among other things, RFK Jr., when he was in the race, had a very kind of I think, very extensively thought out a set of policies and procedures for digital assets and cryptocurrency. Trump also has come out with a fairly publicly pro-crypto stance. It does seem like the Biden and possible Harris administrations have certainly been putting some thought into this, but also maybe a bit more under the radar, so to speak. It's a little bit less of a known quantity, which could be good or could be bad, depending. But, and then relatedly, a large number of donations coming into the campaigns for the US elections have been cryptocurrency related. So this does seem to be taking a very front and center place in this current election cycle. Beyond that, does seem, as I alluded to, that we're closer to the beginning than the end of this current bull run. So a lot of people in the cryptocurrency space will ascribe to roughly 4-year market cycles. And point here being that we seem to be around in the place that we were in late 2020, which was basically right before a run up in 2021. So a lot of folks are basically anticipating very significant activity in the next several months to a year, which makes it an interesting time to potentially capture a lot of upside as an investor. And then beyond that, there's also the broader sense or broader question of what's going on in the world at large. So certainly a lot of macroeconomic and geopolitical questions to be answered, instability. And so we see people turning, not just in the US, but also in various jurisdictions, turning to digital assets as a hedge against that volatility, having a cross-border way to store value, transact, that's, let's say, less dependent on the fluctuations in national currencies with inflation, less dependent on political unrest, these sorts of things. In that regard, I do think we're going to see more tranquility in a way that's good for cryptocurrency in a lot of markets. But that being said, also sometimes lack of tranquility can in and of itself be good for the digital asset space in terms of the types of value that it can provide.
Yeah, it's really interesting times. It's really, and I know we have around 5 minutes remaining. And so one of the questions I have for you is, we've seen this asset class really from like 2008, come into like almost fruition with the ETFs. And, before, a lot of institutions and family offices, high net worth individuals were like, yeah, this is all a scam. But what proportion of your clients are actually, like, for example, institutional, or just, the big money, are asking about this asset class? They're actually paying attention to it and want to learn more about it to diversify or decrease the risk exposure to other correlated assets.
Yeah. So I think everybody is watching in a way that they weren't as much several years ago or a decade ago, certainly. But what people are doing is, I think, dependent on the risk appetite and the focus. For one thing, more anecdotally, but when I do talk with friends and colleagues who are in the digital asset management space, generally speaking, they're saying that most of the value that they're providing is to, say, family offices, high net worth individuals, as well as more kind of the small to medium type of institutions that are looking to really differentiate. So the really large players, they tend to move more slowly, right? It's harder to steer the oil tanker than to steer the yacht, right? In that regard, I think the more individual and also somewhat smaller players have tended to be a little bit more proactive in this regard, and it's stood to benefit a lot of them. It also seems that this next stage is going to be very dominated by more liquid strategies. So a lot of people got into the space more around VC, especially some of the institutions, and a lot of them got fairly burned, where early stage investing in general carries risks, but early stage crypto investing has had higher failure rates than other sort of areas of the early stage market.
Yeah.
So with that, I think when people are looking at entering or re-entering with this next phase of the market, many of them are looking more at those actively managed and or liquid type of strategies.
Yeah, it's really fascinating. Even like pensions, endowment funds, governments, El Salvador, Argentina, they're all looking into this space. one final question is also, what is your view on non-fungible tokens and meme coins? Are these just speculation and outside of your scope, or are you taking a serious look at it before you put your clients' money into these new areas?
Yeah. So the short answer, there is value there, but there's also high risk. So assets like meme coins, non-fungible tokens, especially non-fungible tokens, tend to be considered what's called a trophy asset, where they're, in a sense, the crowning cap on top of whatever someone else is whatever someone's already investing into. It's kind of say like you only buy let's say the super fast flashy car when you already have your basic transportation needs covered. It's like that Maslow's hierarchy of needs sort of thing. So relatedly, they tend to be the last thing to be bought and the first thing to be sold. So they're very high risk, at least in the sense of NFTs as more kind of these artworks and stuff like that. That being said, NFTs as a broader technology also carry as yet under-tapped potential, more kind of real-world utility in a lot of ways that I think the market is still figuring out. So certainly there is value if it's more from the kind of artistic and social and culture perspective.
Mhm.
It's a very volatile and very risky type of value, but value nonetheless. And then from a more utility perspective is TBD. That being said, what we find interesting is in those types of arenas is more picks and shovels type of investment. That's, say, investing into the type of infrastructure providers that facilitate the transactions of NFTs, or that facilitate the communities that are sharing meme coins, these sorts of things, where there are opportunities to basically encourage the development of that ecosystem through investing in a way that is lower risk when it's more focused on the utility.
Yeah, really interesting. How could people, it's like those, how can people find out more about you and contact you, learn more about you, and reach out to you?
Yeah, I'm very active on LinkedIn. We have a newsletter for the company on LinkedIn as well as via email. We post a lot of information about what's going on in the space, sharing info on events as well, both virtually as well as in person. So yeah, I would encourage you to reach out to me. My LinkedIn profile is David Ambrose Doss is the URL. And so it's linkedin.com/in/David Ambrose Doss, I believe. And if you want to just maybe mention Chris's show here so that I, know who you are, or you can also reach out to me and my team. We're at info@ckc.fund, and, be happy to respond to any questions or any ways that I can be of help there as well.
Yeah. And thanks for a really fantastic conversation. I know we could have
Likewise.
gone and for the audience, be sure to reach out to David, and thanks so much for a great conversation.
Absolutely. Thank you again for having me on the show.